Many of the risks of investing in the UK market are similar for other equity markets, namely that of a global slowdown related to trade or tariff wars and a resurgence of issues within the EU. That said, I think the UK suffered a double discount because of perceived fears around Brexit, and therefore actually looks relatively very good value, and therefore is arguably less risky. I think when it comes to hedging Brexit risk, people need to be very careful about how they're trying to achieve that. There's a big difference between different mega cap stocks, for example. Some are actually domestically focused, whereas others are obviously overseas focused. And the difference in sterling's behaviour will have a big impact on how that hedge plays out. I think people also probably need to consider hedging on the upside as well. We think that because the market's so cheap and positioning seems to be very underweight, that there's a real chance the UK market could be a strong performer going into next year once we have more clarity on Brexit. So I think people need to look at hedging on upside terms as well as downside terms. We've deliberately tried to keep a balanced portfolio that should perform well in either perceived outcome of Brexit. We haven't been particularly active this year in the portfolio, so the broad shape of it is similar to how it was at the beginning of the year. That said, we've added some interesting companies like Draper Esprit, one of Europe's leading venture capital businesses exploiting opportunities in the digital economy. We've also beefed up our exposure to UK food retail through Tesco and Sainsbury, and we've switched a bit of our Lloyds exposure into a smaller company operating in the same sector, Secure Trust Bank. Earlier in the year, we took profits in some of our resources names, selling out of CAS Materials in particular, but otherwise we've not been overly active this year. We think Secure Trust Bank is particularly attractive, having repositioned their business model towards higher quality lending. The business is really seeing the fruits of that transition coming through in much higher returns, driving higher earnings growth and ultimately higher cash flow. We're also really excited about some businesses we've held for a long time, things like Ashtead look very good value following the recent pullback, as does Wizz, the Eastern European low-cost airline. And at the larger end of the scale, we're still positive about companies like BP and Anglo American. Very strong results recently and very strong cash flow profiles suggest that there's lots of upside still to come in the equity. We think the performance of Lloyds shares is really symptomatic of the wider UK market. The company is performing well operationally, and that's been reflected in strong earnings revisions coming through, but the market is choosing not to reward that with share price outperformance. We think that disconnect will break in favour of the shares moving up, and probably when we have clarity around Brexit. We're starting to see some evidence of people preempting that, but expect certainly over the next 6 months that we'll look back and see this as a good buying opportunity. Still very optimistic about Tesco's ability to recover its margins in its UK business. When it comes to Vodafone, we've seen the earnings momentum, which we were trying to capture at the beginning of the year, meet a number of headwinds that we weren't anticipating at the time, and we subsequently reduced that position.